So we're thrilled to have you here with us today, and I guess this is all about tax season, and particularly looking at tax filing mistakes and how to avoid an audit. Now we know that tax season can be stressful, and unfortunately for us all, it's not optional. Mistakes can lead to overpaid taxes and even trigger an audit. And this is why today we wanted to take a little bit of a closer look at some of the common pitfalls around real estate tax filing to help you out and maximize your revenue to reduce that risk. And yeah, I'm Logan Ransley, co-founder of Landlord Studio, and we're joined today by Thomas Castelli. And Tom is a CPA specializing in the real estate niche, and he's also the host of the Tax Smart real estate podcast. And he's an expert in helping real estate investors optimize their tax strategies while sort of staying IRS compliant. Tom, great to have you here with us again today.
Thanks for having me back. Always a pleasure.
Yeah, well, good. So I want to just start the webinar by asking you some of the real life tax mistakes you have seen your clients made or make over time, and I guess the consequences of those mistakes. Love to hear some of your insights.
Yeah, absolutely. So we see a lot of mistakes when it comes to tax filing, and I start with some of the more basic ones we see, which should be preventable. Like sometimes we see people filing their rental properties on Schedule C instead of Schedule E. So that's kind of just one. Then other times when they do file it on Schedule E, then sometimes they're missing common expenses like rental property insurance or perhaps property taxes. Just little expenses like that are almost existent on all properties. And sometimes as a result of poor bookkeeping or poor record keeping in general, when they get that information over to their CPA, it's either missing or lost in the shuffle. So that's just, having good bookkeeping, having good records is going to be able to help you make sure you're capturing all of your tax deductions and you're not missing anything if anything's falling through the cracks. So those are just like two of the common ones we see at the high level. We also see people commonly just missing, low-hanging fruit opportunities for tax deductions. Sometimes people are eligible for the real estate professional status when and they don't claim it. Sometimes they're erroneously claiming the real estate professional status, and we may talk about that a little bit more later on. Other times they could be using a cost segregation study and they're just not, or sometimes they're not claiming depreciation at all. Like depreciation is a big expense and you have to take it. If not, the IRS will assume you do. And sometimes it's not claimed. Another tax mistake is not carrying over the Form 8582 every year. So that's if you're a passive investor and you have passive losses, that's the form where it's tracked, and you want to carry that over year to ensure that you can use those later on down the line. We've seen that get lost in the shuffle for people. It can be somewhat problematic.
I guess one of the first questions then is you've sort of talked about some examples. I'd like to talk about worst case scenario that you've seen or heard about when misfiling taxes. I know people can sort of slip up and get a few things wrong, but I guess have you ever seen any cases or studied any cases from your firm of the misfiling tax situation, and I guess what that sort of has resulted in?
I've seen people not file taxes for years on end. I mean, I think that's probably some of the biggest mistakes. So that I always find surprising. So people get behind in their taxes for several years. I definitely want to stay current on that. There's a lot of back taxes, penalties, and interest that can accrue, among other things. So definitely want to make sure you're doing that. Another one is using S corporations for rental properties. And that's a big tax mistake, because what happens is with S corporations, if you need to ever restructure your entity for whatever reason, it could be estate planning, it could be refinancing, it could be asset protection, a number of reasons. If you remove the property from the S corporation, it's treated as a sale. And when it's treated as a sale, if the property is appreciated, then it could trigger significant capital gains taxes, even though you're not really selling the property. So you'd have this tax consequence, but no, revenue, so to speak, or no sales proceeds to pay it. So that could be an issue, and we see that often. So you definitely, from that end, you want to use an LLC that's either disregarded or a partnership taxes of partnership to avoid that. But those are some of the biggest ones that we see from just a mistake perspective.
Yeah, I spoke to someone the other day actually in an S corp, and your previous comments from other webinars was ringing in my ear, and I was like, I don't know if this is the best structure or not, but maybe that
Yeah.
they should head off to you guys at the real estate CPA and get that checked out. But I guess sort of jumping more into around the bookkeeping best practices. What are some of the bookkeeping tips you have for viewers that can help them stay confident at tax time, and how does this sort of relate to the whole tax filing, etc. as well?
Yeah, absolutely. So it's garbage in, garbage out. So when you give your CPA or your tax preparer, or if you're doing your own tax returns, and there's a profit and loss statement that goes along with each of your properties that you have. And if you don't have any bookkeeping, that could be extremely problematic because, like I kind of referenced before, you could be missing out on expenses. Not only that, but when it comes time to file your taxes, if you have to go back in January, February, March, or April and go all the way back to the prior year, try to recategorize everything, get everything organized, it could not only take you a lot of time, but you're often going to be missing things, forgetting things, because it's hard to remember what happened 6 months ago, right? So one of the biggest things you can do from a bookkeeping standpoint is you start using a bookkeeping system as soon as possible. When you like, the earlier you could do it, when you first start buying rental properties, the better. And additionally, doing it on a monthly basis or at least a quarterly basis can help eliminate a lot of those issues with just discrepancies and it just getting all backed up. Because and not only is there things that could be missing and just a lot of your time, but oftentimes if you give your CPA just a bunch of um, Excel spreadsheets and documents, they have to go and piece all of that together, which takes them more time. It's probably going to cost you more money. It may delay the filing of your tax return because they have to put all of that stuff together. So, bookkeeping best practice: get on a bookkeeping system sooner rather than later. The sooner the better, and just make sure you're staying current on it. A monthly is good, is ideal. Quarterly could work, but if you're waiting to the end of the year to get this done or the beginning of the next year, it can just slow a lot of things down for you.
Yeah, we've heard this a lot before, especially around the spreadsheets. And actually, one of the most common reasons why people jump into the Landlord Studio is they've gone on a spreadsheet and it's just become unmanageable, especially as their portfolio starts to grow. One area that can be tricky is understanding the nuance between sort of repairs and
Yeah.
improvements. And I guess this is especially true for new properties with, I guess, the placed in service date coming into play. What's your advice to help landlords tell them apart, and how do they need to be treated differently?
Right, right. So, yeah, let's start here. So, like, whatever you do to your property prior to placing the service, which is the date it's rent ready and available for rent, like someone could move in if you wanted to sign that lease agreement, is everything there is capitalized as a capital improvement and going to be depreciated along with your property. Now, once your property is placed into service, things start to get a little bit more gray, right? You have repairs and maintenance expenses, and then you have capital improvements. Capital improvements are typically larger renovations or improvements to the property that are going to last longer than a year, and those need to be capitalized and depreciated over several years. Whereas repairs and maintenance expenses, they're immediately deductible in the year that you incur them. There's a few things that kind of help with this, help make this easier. The first one is some safe harbors. There's a safe harbor called the de minimis
Mm.
safe harbor. It's one of our favorite safe harbors. If you have like an expense that's $2,500 or less, in that like repair, maintenance, and capital improvement category, you can write that off as an expense. You're typically going to be able to write that off immediately that year. And that's an administrative convenience because, imagine having to capitalize, track, and depreciate all these small little components. Doesn't really make sense. So that's kind of the first line of defense to see if it's a repair or a capital improvement. Is if it's under $2,500, usually going to be a repair expense. The other things, there's some tests. They call it the BAR test: betterment, adaptation, and restoration. For example, if you're doing something to your property that's making it materially better. So, for example, if you were to replace rotting wood planks on a deck with brand new weather guarded. I don't know the actual material name offhand, but these better materials that are going to make the property last longer. That's usually going to be a capital improvement. It's going to be a betterment. Whereas, say you're just going to replace a few of your wood planks on your deck and not redo the entire thing, that's usually going to be a repair, right? So if you're totally redoing something and bringing it back or like improving what it is, that's going to be a betterment, which has to be capitalized. There's also something called a restoration, and a restoration is where you're restoring something to like new condition. That's also going to be a capital improvement. So you'd see that a lot with HVAC systems.
Mm.
If you're totally rebuilding the entire HVAC system or materially improving it, it's going to be a betterment or a restoration. Whereas if you're just replacing a component of that HVAC system, that's more likely going to be a repair or maintenance item. Then there's an adaptation, which I'd say is a little less common, especially in the single family or small multifamily space, where you're adapting the use of it. So, for example, say you had a garage that you're now adapting into an apartment. Like that would be an adaptation. You're changing the use of what that is. Another example of that is a little bit more extreme would be if you have a warehouse and you're turning that warehouse into self-storage, if you're turning that warehouse into apartment units or something along those lines. That's an adaptation. You're changing it to a different use. So those are just some things. It's a lot. It's a little complicated. There's entire regulations, like 1,400 pages, called the tangible property regulations that govern this. But those are just a few things that I could kind of point out. It's like if you're just repairing something, if say example, you had 10 windows, right, and you replaced one of the windows, that's probably going to be a repair or maintenance expense. If you're totally overhauling all the windows in the property, that might be considered a capital improvement. Larger renovations, like a gut renovation, that's going to be a capital improvement. Some of these are more bright line, easy to tell. But when you get into some of the nuances, that's where you have to really step through. Hey, does this qualify for the de minimis safe harbor? If not, then is it a betterment, adaptation, or restoration? And if it's one of those, then you're usually going to have to capitalize it.
Yeah, and I think this is, this is a really important note for everyone on the call today, on the webinar today. There is a lot of regulation around this, and this is why we do recommend working with a real estate specialized CPA. And that's what Thomas and his team can do. So rather than you reading through 400 or 1,400 pages of all this content and trying to get your head around it, let the professionals do it, and they can help you maximize those tax savings as well. We'll share some info around Thomas's business right at the end, but sort of just going on, another thing that I sort of see is landlords struggling to track their mileage and travel expenses. Most often, most people just don't do it because it's too much hassle. But I think there's quite a significant loss here. Do you have any tips around this and what landlords can do to sort of maximize deductions on mileage specifically?
Yeah, so there's a few things. One of them, the first thing is having a home office. So if you're managing your properties or self-managing them, then you can have a home office. And with the home office, what that does is that turns your house or your home into a place of business. So that means that when you drive from, say, your home office to the bank or to your rental property, to Home Depot or wherever business location, that becomes tax deductible. If you didn't have the home office, then that commute from your home to your first business location of the day, that's a personal commute, and those miles are not tax deductible. So that's just one element that could help you really maximize your vehicle deductions. The other element of it is tracking, and it's one of those things, in accounting where you have to track a lot of things. There's software tools out there that you can have apps that allow you to track your mileage. So you definitely want to take advantage of one of those. It makes it easy for you to track those. You could also use like a spreadsheet or something along those lines, although I'd admit that's a little bit more tedious these days. I would definitely recommend an app. But those are the two key things I'd say from a mileage standpoint is if you can have a home office, then use the home office. That will help increase your mileage deductions. And then just being sure to track it. Those are the two major things that could help you maximize your mileage deductions.
Yeah, super interesting. And one thing would note for those who are using Landlord Studio, we do have a full automated GPS mileage or tracker built into the software. So you can track everything on the go, all automated, and we'll track all your logs, etc., just to make doing that a lot easier. So definitely go check that out as well. Just want to briefly talk about deductions in general. What are some of the most overlooked tax deductions that landlords should be aware of? And I guess things that we haven't really touched on already.
Okay, yeah, a lot of deductible expenses, like just the basic stuff. I think if you look at Schedule E, if anybody's out there who just kind of wants to get an idea of some of the common expenses that you have on there, you could see those. I'm not going to go through those too in depth. I think it's pretty standard, but a lot of times people are missing HOA fees, bank fees, so bank costs from your bank. A lot of times people are missing depreciation. I know I kind of mentioned that before, but I just want to hit that home. Like you need to take your depreciation expenses, make sure that you take it. That's a big one. But yeah, I mean, the basic stuff is a lot of times what people are missing and overlooking. So again, Schedule E, I could sit here and go through that, but I just don't think it's worth people's time.
Yeah.
But yeah, the biggest one that I see people overlooking is depreciation. To be honest, and that's a major one.
Mm. Depreciation, it can be complex, and again, this is why we sort of recommend working with a CPA. For Schedule E clients and users here, you can jump on our website, and we have a lot of content on the Schedule E specifically. So if you want to learn more about that, you can there too. So I guess we've covered a lot of common mistakes, but let's sort of talk about the consequences and specifically about IRS audits. What is the IRS looking for, and what are some of the things that are more likely to trigger an audit for real estate investors? And I guess what can investors do to reduce this risk?
Yeah, I would say so. So what the IRS does is they have like indexing with like their systems, and you electronically file your tax return. That they'll look at your tax return, and if expenses are excessively high compared to what they should be for any category, and a good one is repairs and maintenance. If that's excessively high, they might audit you and look into that. Well, are some of these really capital improvements? That's one of the top things that someone can get audited for from a rental property perspective. Another one that can trigger an audit is having too much like in the miscellaneous category. So if you look at your Schedule E of others sometimes there's just expenses that people are deducting that are just excessive, right? Like meals, for example, that could be a big one. Like if you have these excessive meal expenses, that could be a red flag from the IRS to go in there and investigate. Well, were you whining and dining at these excessive dinners? Like, was that really necessary? Are you taking advantage of that? That could trigger an audit. Also, more recently, what we've been seeing is audits around the real estate professional status and short-term rentals. So if anybody's listening to this and you use the real estate professional status or the short-term rental loophole or strategy or rule, whatever people want to call it, if you're taking these non-passive deductions, you're going to need to document your time to prove that you met those requirements, and that's going to be the biggest thing. Because if you have a W-2 job, right, and you're claiming the real estate professional status, that's a huge IRS red flag, and that's something that could flag you for an audit, because they know that if you have a full-time W-2 job, you're not going to be able to make the requirements for the real estate professional status. And just to recap what those are for anybody who may not be aware, it's 750 hours and more than half your total working time in the real property trader business. And if you meet those requirements, you could take the losses from your rental properties against your active income or your earned income, but you can't do it usually without it. And that's the big red flag right there. So if you're going to be using the real estate professional status, make sure you don't have a full-time W-2 job, and you also make sure that you're documenting your time, because if you do get audited, that's going to be key. And the same thing goes for the short-term rental. Short-term rentals, you need to document your time. It's a little short-term rental is a little bit easier. You don't need to be a real estate professional and meet that 750 and more than half your total working time requirement. But if you are using the short-term rental strategy, you do need to have that time log ready to go.
Yeah, very interesting. And we have a lot of other webinars that we've done with Thomas around this specifically, and we go into a lot more detail of why you can't claim that status if you have a W-2 job. There's been a lot of case studies around this, and unfortunately, not many people have won that when they've argued it against the IRS. So if you need more help on that, or you need more consulting, definitely reach out to a CPA to speak about that a bit more. So, sort of just going on, if a landlord does get audited, what does the process look like, and what should they do to prepare for that?
Yeah, so usually what's going to happen when you get audited, you're going to get a notice in the mail typically, and that notice is going to have a deadline. So if you do receive an IRS notice, do open the letter as soon as possible. Don't delay, don't put it off, because the longer you wait, just the harder it's going to be. So if you get an IRS notice, open it up, read what they're saying. The next thing I would do is I would consult a CPA. And it's not at all to be self-serving, because we've seen so many people try to start the process alone, thinking that they're going to be able to beat it, just to get so far down the line that they've already messed up, they've already lost. So first thing you do, receive the notice, open it, contact your CPA, have a conversation with them. What do we have to do for this specific audit? Because audits are different. It could be they're auditing your repairs and maintenance. It could be that they're auditing you for the real estate professional status. It could be that they're auditing you for something else, like cost segregation. Sometimes we see audits for there too. So you definitely want to get linked up with them. From there, you're usually going to provide the information that the IRS needs for that particular audit. And you usually want to provide that information and that information only. You don't want to over provide information to them, because if you provide too much information for that to them, you might be exposing yourself to additional risks. And that's why it's important just to work with the CPA on it. But then what's going to happen is from there, once that information is submitted, sometimes the IRS will say that's satisfactory and that's it. You're done. You're good to go. Other times there's going to be some additional communication, the correspondence back and forth, trying to piece together the puzzle and kind of iron everything out. And then if you win, great. If you lose, you might owe back taxes, penalties, and interest. So, I mean, the biggest thing I could say is when you get that letter, don't run from it. Open it. I think one of our staff members said that when they scan one of our clients, when they scanned their documents, they scanned the audit letter, but they didn't even open the letter. Like that's how it's like you have to open the letter for us to see it. So like some people are just that fearful of it. Like don't do that. Open it up and take care of it. So that's pretty much the process.
Yeah, interesting. Yeah, and I guess that's a very strong reason why you should keep on top of all your bookkeeping, keeping all the records, and keeping it all in one place. Can be messy otherwise.
I just wanted to say real quick, yeah, I can't believe I overlooked that. Like if they request documents and you don't have your bookkeeping in order and you have to hurry and scurry to get that together, that could be problematic for you. So it's another reason to have your bookkeeping in order.
Exactly. Yeah. I mean, don't do anything last minute. Really, you should build a behavior where you are tracking things constantly over time and not doing it all at the last second. And that goes for tax filing, any sort of management around rental properties, and particularly to prepare or mitigate the risk of an audit. So I guess sort of moving on, we want to look at the solution to this problem. And I guess proper record keeping is probably the number one thing that real estate investors can do to reduce that stress, maximize their deductions and ROI, and obviously avoid that audit. And it's crucial, and that's exactly why we built Landlord Studio. So there's been a lot of comments in our webinar today. I'm just reading through them all. Some great comments in here, actually. Few users not using Landlord Studio. And I guess this is why I want to cover off some of the features and how it can help you. Landlord Studio was built to make income and expense tracking easy for real estate investors. When you use Landlord Studio, you can collect the rent online. Someone asked about Dwolla. Dwolla is a payment facilitator that we use. We're about to introduce Stripe as well for credit cards coming up soon. And so basically this feature helps you collect rent online from tenants, and then we automatically track all that income in the product, basically allowing you to facilitate payments through our product. You can also leverage the automation tools like the bank feeds. And so we use Plaid to integrate into your bank account so you can pull transactions in and then assign them to properties. And this strips out a lot of the manual effort that's required if you're using a spreadsheet otherwise. You can also use our smart receipt scan to automatically capture receipts and invoices and store them on file, and that built-in GPS mileage tracker as well. So all these little features that we've added in really help you stay on top of bookkeeping and help you automate a lot of the process in your business. And plus, leveraged automated reminders. It's not just a income and expense tracking tool. We do have the property management features that wrap around the outside. So this is everything from tracking leases to tracking late rent to tracking the balances on that late rent, recurring expenses, recurring reminders. We help with all of this, and we reduce the manual data entry by helping you with all these features. And then when tax time rolls around, all of our reporting, we have about 20 plus reports that you can generate, from the Schedule E to profit loss to breakdown statements to the 1099 supplier statement that you need for 1099s, everything that you sort of need to do your taxes. And if you have a CPA, help them do your tax return as well. And so, yeah, again, sort of summarizing, it's an all-in-one software. We do the full end-to-end cycle. Some of the features that I haven't covered, which sort of relate further on in the year, is around listings and tenant screening and syndication out to Zillow and Zoomper and all those sites. So it really is the sort of all-in-one, with the very core component of focusing on the real estate income and expense tracking tool, so that you can stay on top of your finances. And so I guess sort of covering it off in the 6 components here again: property accounting, tax reporting, rent collection, and there's also that maintenance as well. So if your tenants need to raise maintenance requests, they can easily do that from inside the app. So yeah, that's a bit of a summary about Landlord Studio. We've sort of quick-fired through some of this content around the audit side. I think some of the key components that we've covered off is making sure that you're on top of income and expense tracking, you're maximizing tax deductions through depreciation, etc., which we recommend a CPA to do. I'm just going to open the floor up for a Q&A. I know there's a few questions in here now. There was one question I saw around claiming expense meals while traveling to a property from a home office. Could you speak to that, Thomas?
Yeah. So when it comes to deducting meals, when you're traveling, they call it a tax home, which is the city or general area. Maybe you call it the MSA, if you will, of where your business is located. When you're traveling within your tax home. So say, for example, I traveled from my home office to the property, 20 minutes away. That's not going to, your meals when you're traveling, and that's not going to be tax deductible because that's in your tax home. However, it would be tax deductible if you are having a business meal with an associate or a business contact, right? That's the difference when you're within your tax home. Now, when you're traveling outside of your tax home, for example, if you live in Florida and you go check on your property in Texas, now your meals will be deductible because you're traveling outside your tax home. So that to summarize that, your meals are, first of all, meals are 50% tax deductible, not 100% tax deductible. But if you're within your tax home, not going to be tax deductible unless you're with a business associate. If you're outside your tax home, they're going to be tax deductible.
Hopefully that answered the question. A couple more questions before we sort of wrap up today. David, anything that will help with Airbnb properties? So Landlord Studio can track everything for Airbnbs or one-time leases. There's different tax rules around short-term rentals versus long-term. So we would suggest to consult with a CPA, reach out to Thomas's team to talk about that. But from a purely logistical point of view, you can use the product or Landlord Studio to track short-term rentals. Ray, can Landlord Studio track rev and expenses for multiple properties? Yes, you can. So you can add as many properties into the system as you like, and further, you can add as many flats, units, doors against those properties as well. So you can actually break down the P&L all the way down to the unit level and track the lease at the unit level, and effectively break out all the expenses across all the different properties and units. Damon, any special considerations if filing as an LLC? we sort of touched on this a little bit. I would suggest reaching out to Thomas's team. They can give you a full presentation on and consult around, I guess, the considerations of an LLC, the protections that come with it, the tax benefits, etc. That would probably be my recommendation, which will, and I'll give you a link to Thomas's website after this. And yeah, I think that will be the best way forward for you there. And then I guess one more question. Can you reverse the structure of an S Corp to an LLC? Probably quite a difficult question for me to answer. Again, I think Thomas could spend quite a bit of time explaining that and going into the depths of that as well. So I definitely recommend reaching out to his team. I'm just going to drop the link to the website, the Real Estate CPA, once more, just in the chat below. For those looking for more information about Landlord Studio, just reach out to me, Logan at landlordstudio.com, and then I'll be happy to answer any questions there and go through a demo as well. So just going to wrap up today's webinar. Thank you very much for joining us, and huge thank you to Tom for sharing all his expertise. Thomas, again, if the watchers want to find out more about you and more about the real estate CPA business, where should they go? I've obviously put the link in the chat below, but yeah, what other information can you share?
Yeah, I would say check out the Tax Smart REI podcast. It's out on all major podcast platforms, so Apple, Spotify, YouTube, so on and so forth. It's a great resource. We go in depth on real estate taxes on basically a weekly basis, and we have over 300 episodes and counting. That could be a real value add if you're looking for that. Otherwise, the best place would be the website. So Logan dropped the link in the chat. You could also go to therealestatecpa.com/landlord studio. That either link works. And if you're looking for a new CPA or want to see how you can reduce taxes, we'd be happy to have a conversation about how we can help.
Awesome. Well, appreciate everyone joining today. And if you're ready to dive into Landlord Studio, feel free to jump on our website. There is a 14-day free trial you can check out. But until next time, I hope you've enjoyed this webinar. The replay will be up online. And again, thanks, Thomas, and we'll see you shortly. Cheers.
Thanks for having me.